G'day folks, welcome back to another update for high-grade copper and US crude. Now copper seems to still be consolidating, although it's slightly bullish, whereas US crude oil is continuing in a downtrend.
Which way do we go? Which way do we go?
Before we go any further, make sure you hit that like and subscribe button to support the channel and reference the +1 videos to get a deeper dive into some of the trading strategies we talk about. Near-term outlook sees copper as relatively neutral to bullish, supported by supply disruptions and long-term demand drivers tied to green energy, electrification and technology infrastructure. Though demand risks remain if global growth slows, in contrast, US crude oil looks under pressure with oversupply and rising inventories, likely keeping prices subdued into 2026, unless major supply disruptions or demand shocks reverse the trend. So first looking at high-grade copper on the weekly chart, and the price is above the moving averages, which gives us a slightly, a bullish momentum at the moment. I'll say slightly because notice the CCI has dropped into that moving average range, and that's a weakening signal. I'd like to see that CCI break above that moving average to be more bullish in line with the price. So at the moment, a bit of consolidation happening in the last few weeks, and there's no divergence currently on the weekly. On the daily, that's also showing that consolidation period. Now also notice the price is just above that very narrow moving average range, and that moving average range when it's constricted shows the consolidation. You can see here when it was rising, the moving average is separated, likewise the CCI, and here the CCI is below the moving averages. So on the daily, somewhat neutral to slightly bullish on the daily, and there is no divergence on that one. On the hourly, we always look at the different time frames to get an idea of how the overall charts are moving. Here we've broken slightly above the moving average on the price, and also a fresh breakout on the CCI. Again, early days, but in terms of we want to trade in direction of the daily. So at the moment, the daily is neutral, so probably avoid trading long or short until we see a more decisive move on the daily. But here on the 1 hour, it shows a very slight early time for a potential bullish move. So I would stand clear until that was made more apparent. Now going back to the daily for a moment, we take short positions from that point when both the price and the CCI break lower, and here it was consolidating, to show you the effects of the consolidation going short. You can see there you would have taken short positions when the moving averages started to turn down on both the price and the CCI, and you would have closed it out when the CCI and the price started to break up again. Also, for those new to the channel, when you start seeing the CCI rising like that and the price also starting to consolidate, that's giving you an early warning. That was a bullish divergence. That's an early warning, so you would have closed your positions at that point. You may have had a contract open, but it better close it out and save your capital. Again, avoid going short or long during that period. Remember, going short in the direction of the daily, and start going short from this period when the price and the CCI declined, and closing it at that point there when you see that CCI break higher, and then also the price. And you would have avoided those drawdowns, by the way, if you're averaging down using this strategy. And then more recently, again, you probably wouldn't have been going short. You might have started going short there, and you would have closed it out maybe with a small break-even gain there, and avoided going short until possibly, that would have been a false break actually. So you would have. That's why I wanted to see the moving averages turn down. They turned down there, although not too strongly. That was a better position to go short when you start seeing those moving averages turn down. So looking at US crude oil now, on the weekly, the price is below the moving average, and the CCI is skimming just below that moving average range, which means you can take short trades on the daily a bit more comfortably. On the daily, likewise, both the price and the CCI are trending below the moving averages, so taking only short trades if you're trading on the 1 hour time frame. Again, remember, always trade in direction of the higher time frame.
They always follow the strategy.
So there's no divergence currently on the daily, and looking at the 1 hour time frame, you can see there had a bit of a roller coaster event to the downside, and you'd be coming close to entering a short position when the price breaks below the moving average, but wait for that CCI also to break below the moving average to go short, to be a better probability of success. Like back here, for example, that fresh breakout below the price and the CCI, and you would have closed it out. A couple of ways of closing it out, and I'll demonstrate that on the back test. But one way to do it, if you're trading, for example, on the daily, let's go back to the daily for a moment. You want to close it out whenever you see the price, for example, breaks below there on that candle, and you close it out when the moving average of the CCI is penetrated on the CCI there, and that's near the bottom of the price range. Rather than waiting for the price to rebound into that moving average range, the CCI gives you an early exit. Likewise, a couple of false breaks here. The price was consolidating again with those constricted moving averages, and you would have gone short again, probably on that arrow there, that one there, and you would have closed it out. That would have been probably a break even as well, going short again and closing it out again. When you see that CCI coming close to that moving average range, you probably could have got out early, take your money, or at the very latest got out on that candle there, and so on. Now going to the back test, remember going short in the direction of the daily. This is the 1 hour time frame. You would have taken short positions. This is the other way of trading it, trading with the moving averages on a downtrend and the CCIs on a downtrend, and wait for the price to start to break up. You probably could have closed it out at one time there, then re-entered again there, closing it out again there, re-entered there, closing it out, and then so on. And where we are, and that way you avoid these drawdowns. You can see these drawdowns happen when the price goes against you. When the price is in your favor, let it go with a couple of average downs happening. They're minimal average downs, but when the price goes against you, like in these cases, the average downs really impact your account balance. And where we are at the moment, again, as I said, you'd go short during that period, and you'd probably close it out somewhere there, hold no positions, and then entering another position there, and getting ready to close it out, but probably wait for that moving average range. That's like I like to see it zoom out. I like to see those moving averages start to turn up. So this could actually fall further. You've got to give it time to breathe sometimes, but that's just another way of trading it. If you want to get some share trading ideas, want to subscribe to the weekly bullish share scan. These are some of the trades we've taken since the 21st of September this year, generating 5,800 in Aussie dollars, and that equates to 11.57% return.
Really?
So to get access to those scans, subscribe to the Patreon page, links in the description below. Hit that like and subscribe button. Thanks for watching, and see you in our next update.